Priya Sundar, Director Peak Alpha Investment Services Private Limited. Kapil Mehta, Co-founder Secure Now Insurance Broker Private Limited. Mahavir Chopra, Director Health, Life and Strategic Initiatives Coverfox.com.
Good morning, everyone. In this panel discussion, we'll talk about the role of insurance in your money box. When you think about money management, the words that crop up in the mind are investments, savings, real estate, and also definitely tax saving. But how often have you wondered if you're insured enough? Do you know that even before you pick products for wealth accumulation, you need insurance. You need insurance for your life, for your health, for your assets. But insurance is not very popular unless, of course, it comes bundled and then you pick up 52 policies, as Nitin was mentioning earlier. So as we enter a new financial year, let's try and get the right perspective on insurance. Let's talk about some smart strategies to pick important insurance covers and also look at how technology can aid our buying decision. So I'm going to start the discussion by asking each one of you, how do you think an average customer views insurance? What's their approach? And what should be the right approach? So Priya, since you're a financial advisor, I'll start with you.
So, as financial planners, Peak Alpha has been in business for nearly 12 years now. We service more than 3,500 customers. And coming at the back of that experience, I can still say that today insurance is not a pull product, it is a push product. And people have to be told the importance of insurance and the difference it makes to their life. So when I say I'm selling insurance, I'm not actually selling insurance, I'm selling what it can do for you and your family. It's not about talking about debt, it's about doing the right things for the people you love and for the people who are going to live. So when you're looking at how much insurance cover you need, you can look at it from various perspectives. One very easy way to look at it is to say, well, if you die tomorrow, right, what are your future cash flows? What are your future income streams, right? What is the rate of growth of that income stream? And then you do a present value of future cash flows, and then you come up with the extent of income that you could have generated, and you kind of replace that entire amount. But that's one way of looking at it. But people may say that that's not what I'm looking at. It's, if I just want my family to be financially independent, what should I be looking at? Then we break it down into three parts. We say first, look at liabilities, right? Cover your liabilities first. So if you have a home loan, if you have personal loans, whatever, car loans, that's something that you need to look at first, because if you're not there, not only will the income stream go away, there's also a loan that needs to be repaid, and that's quite a burden on the family. Second, we look at what does the family need to be able to make sure that the routine expenses are met. So we call that the family welfare fund. So typically, if you say that I spend maybe a lakh a month on routine expenses, roughly about 12 lakhs a year, then how much insurance cover should I need so that if I die, that amount should go into the bank, and if it generates about a 7% interest for me, that interest alone is enough to take care of my family expenses. That's another way to look at it. The third thing we look at is, what are your non-negotiable goals in the future? Is it children's education? Is it my children's marriage? Buying an asset? Whatever it is that you don't want to compromise on. You start planning for that right away and make sure that those goals happen no matter whether you're there or not. So that's how we look at insurance.
But when the customers approach you, when your clients approach you, what are they thinking when you talk to them about insurance? What's the mindset regarding insurance?
Dipti, we are coming at it from a financial planning perspective, right?
Sure.
So we will talk about everything. And I think risk management is, somebody mentioned earlier, a basic fundamental block of financial planning. You cannot plan for the upside unless you plan for the downsides. You have to create the right base, and only when you have the risks covered can you start planning for money and growing your wealth in the future. So that has to be made very clear. And once that is clear, people get it. And then you deal with insurance at different levels. People may not want to take a high level of cover at one stage, but then you approach it. Every time we do a review with a customer every 3 months, we are making sure that different risks are covered. But at the end of the day, I also think that insurance is an expense, right? So when you pay a premium, right, what is the basic mathematical equation here? The premium plus the growth in that premium is going to pay your future claims. It is also going to pay for the profitability of the insurance company, and it's also going to take care of the overhead costs of the insurance company. So to the extent that you can self-insure, right, it technically means that the premium that I pay and the growth of that premium can pay for my future claims, and you're avoiding the overhead costs and the profitability of the company. So to the extent that you can self-insure, it's a good thing, which is why some of the emergency fund discussions that the previous panel was talking about comes into play. But insurance is about a very high impact event,
Sure.
and a very low probability event in the future. So those are the big things that you must think about, right? And when you're talking about those events, it doesn't make sense to self-insure. I'm just saying that people tend to mistake insurance for, oh, my dental procedure wasn't processed, the claim wasn't processed, or my car got a scratch and my claim was rejected. Those are not the reasons you take insurance. You don't take insurance for those reasons. You take insurance because of the fact that there are some very high impact events that may happen in the future for which it will completely derail your financial plan. And that's why you take insurance, not for these things. Otherwise, you just get so bothered with the hassles of claims not being processed or not being honored. It's just not worth it.
Sure. Kapil, what's your take?
So, Dipti, I've been in the insurance business for about 13 years now, distribution, and mostly in distribution. And generally what happens is when, let's say I'm at a social get-together with people who don't know me, and there are 10 people standing in a group, and I introduce myself and I say, look, I'm from insurance, 8 of them go away. And the reason they do it is because they think that I'm going to sell them insurance. I've got a short-term nature. I'll just sort of force something onto them. 2, maybe 3 people stay, and with them we talk about risk, and we talk about products, what can happen, what the role insurance can play, what is the right thing to buy, and you should buy it when you don't need it. All the right things about insurance. And I hope that they go away with a little kinder view on insurance. But really, in a snapshot, I think people view insurance in a very short-term manner. They come to buy it when they need it. So, health insurance, people realize they're going to fall ill or somebody's not well and they come and buy it. So of the applications that are made on health insurance, if 100 applications are made, only about 60 go through, 40 get rejected because they came with ill health. I think that has to change.
That's true.
Yeah.
Gopal, what's your take?
Okay, so when we say insurance, obviously there's quite a few things around it. Let me start with life insurance. So I think life, if you do an poll in this audience here, I don't think any of us think we will die. So we are all immortals. So therefore, life insurance, whether it's talking about death or even living longer and selling an annuity product, it's not something that actually people want to think about. So they all end up buying a savings product by and large. So as I keep saying that people think they bought idli but ended up buying a pizza. So it's not necessarily life insurance that people, an ordinary person whilst doing financial planning thinks about it as something can happen to me and then my family shouldn't be on the streets. So that's on the life insurance part. On health insurance, I think there's an increased awareness that yes, things can go wrong. So I think it's becoming a part of the conversation at least. But there again, as one of the panelists said, that if I catch a cold cough, it should pay. So that's a high probability event which insurance will not pay. And I think when we speak about personal lines in general insurance, I think largely it's only motor insurance that gets talked about. I don't think people actually really care about home insurance,
That's right.
which actually is an important one as well, for at least for contents, and if the building collapses, staying out somewhere for a period of
And we
time.
will talk about
I
that
don't
as well.
see that being talked about by anybody, home insurance.
That's right. Deepu, what's your
Yep. Deepti, I think your query was very specific to, what's in the customer's mind, when he thinks of insurance. So we did some research recently, and what we found is that the typical prospect, I can't even call him a customer, comes back and says that it ain't going to happen to me. And we also checked with some academicians, who did research, and one very interesting finding came out. A lot of people said, that what has to happen will happen, right? It's not going to change by buying insurance. So that tends to be, the typical mindset of, customers when they look at insurance. The other aspect is this entire buying process, they don't view it as fun. For example, if you look at a credit card process, you got a flashy credit card, which you can keep showing, right? Insurance you tend to avoid in your mind because you only invoke it during bad times, right? So there's an avoidance behavior in the customer's mindset. Now what we need to do, there are two aspects. One is that we need to create that need, which is why it's a push product, and build awareness. The second is how do we make that buying process, much more fun. And I'll talk about that more later, but right now, this is what we have seen in the customer's mind.
Okay. Mahavir.
So I completely agree with the panelists here. I'd just like to add a couple of more points. From my experience dealing with the customers buying insurance today, the view that I get is that most of the customers today, or the population that you look at, meaning even the well-read, educated population, is a lot religious, right? We are a religious country, right? Where if you look at our background as a culture, we're a very religious country. We feel that God will take care of us. When we buy a car, we'll not look at airbags, we'll look at putting a God idol first, right? Or we'll not understand the safety features as much as we'll try to understand about how the car is cooler or looks cool, right? That one. And second is that because we come from joint families, there are a lot of risk gets covered because of the buffer that exists across a large family that works together, right? So there are two shops, or there is work being done by three family members in the household, because of which the way people look at insurance in India, and particularly any other culture which is closer to how India is, will always have this aspect of not understanding risk the way it should be understood. If you look at today the entire insurance pie, right, meaning even life and general, and if you try to break it down and try to find out the voluntary purchase of insurance, it will be a very small pie of the total insurance that is purchased. A customer going and buying insurance on his own, not being pushed or not being attached to a product like you just mentioned, is a very, very small pie of the total insurance that is sold in the market today. So that actually reflects on the culture and the way the mindset today is of the customer.
Okay. So I think it all boils down to the fact that you need a very proactive approach towards insurance, and also think of insurance as, covering huge impact events. With that in mind, let's get into product specifics. Let's talk about product strategies. Now, let's pick life insurance first. Term insurance is the best product for life insurance. But even now in the market, there are various kinds of term plans. Term plans have seen a lot of innovation. So you have, the typical lump sum benefit. The beneficiary gets a lump sum on death of the policyholder. Then you have something called as a staggered income, where you can stagger the lump sum to pay a periodic income. Then there are combinations. Then there's an accidental death benefit built in. Then there are terminal illness plans built in. So I want to understand, when you're approaching even a term plan, what should your smart strategy be? Gopal, I want you to answer that question.
Yeah, I'll first start with explaining term, why
Sure,
it's
sure, yeah.
not popular. So it's a fatalistic society. Nothing happens to me. So I always keep saying that in an apartment building, if there are 2 floors on an apartment, my neighbor can eat 100 grams of butter every day, and he will think I will die, not he. So that's the mindset with which we come from. Therefore, the first question that always gets asked is, what do I get at the end of the term? It's a given that I will survive, whether it's 20 years, 30 years, 40 years. Actually, now people are asking for a term that goes till age 100. And the first question is, at age 100, what you will give? I said, okay, so let's talk about it, right? So if everyone is going to live till age 100 and ask for a lump sum at that point of time only. So firstly for term, therefore, I think a lot more awareness needs to be created as an industry, not just the insurance companies, everyone put together, including people like you, on saying that if you look at life insurance, buy term first, and then look at anything else later, even if you want to do a unit linked or an endowment. Now within term, what is term? At the core of it, it's very simple. Uh, when, uh, when someone dies, or if that person dies, the family should have enough money to sustain their living standards. And if there is a loan that has been taken, it should pay off the loan. So therefore, a lump sum is a preferred option to begin with. But also we understand that in a society like ours in particular, if a lump sum, let's say there is a 2 crore of sum assured that gets paid out when the main person is dead, the family is under emotional stress, that's number one. The claimant may not be financially literate or financially aware, that's number two. Third is I call them vultures. There are others who will just land at the door saying that we will tell you how to deal with this money. You know? So for those kind of people, it's better to look for a regular income product, so which may pay a fixed amount every month for a period of, let's say, 5 years or 6, 7 years, until the family finds a replacement for the income that they have lost through the death of this person. So I think end of the day, it's pretty much simple, either a lump sum or a regular income, or maybe a combination of these two. So beyond this, of course, there are many variants that have come into the market. That's largely because you don't want to compete only on price all the time. So okay, so why don't I pay simply, instead of paying a flat regular payout for 5 years, let me increase it at 5% every year. So these things, end of the day, only tries to complicate the segment. It's not necessary that there is a big market out there for all these variants. So just to conclude, therefore, I will say it's a lump sum, depending on the ability of that individual to deal with the money. And if the claimant is not necessarily equipped to deal with a lump sum, then a regular payout over a period of 5, 6, 7 years is what they should select.
Okay. Mavi, what's your take?
So I think when we speak to customers, what we see is that there is a lot of inertia, right? Even though he has been pushed to buy a term insurance, or most of the people that we speak to have told us that, I'm looking at buying term insurance from the last 2 years, right? So the way we look at the problem is that there are two ways we can look at it. One is that I try to chart down all the problems that he has, or the way he looks at his life, and like what KSG just mentioned, that you break down the problem into what are the things that his concerns would be for his family when he is not around. And then you make a product for him, meaning basis whatever products are available in the market. That's one. The other is you make it very simple. You tell him that you solve one large problem. The large problem is that you solve the problem of getting a lump sum when you're not around. That's all. We've tested both with customers. And what we've seen is that when we've kept it simple and we've said that, okay, you just solve this problem, forget all the riders, and don't look at the riders, we've been able to have more customers buy, right? And it's not from a point of view of conversion that I'm talking about. It's not from a sales point of view that I'm talking about. Even people within our organization, we've seen that when we've kept it simple, I think it makes more sense to solve the larger problem for the customer and break the inertia that, okay, if I talk about 2 riders to him, which he doesn't understand, first of all, he doesn't understand. I'm saying that let's look at a customer who is not from a financial services background. He doesn't understand insurance. He's actually scared. He feels that there is a scam going on. That's the whole picture he's created, because he reads Facebook posts, he reads social media, and he comes to know that, okay, people have been not paid claims. There are more bad news about insurance than good news. In that whole framework of his mind, if I'm going to teach him or educate him over a call or over the internet about multiple features and multiple benefits, it does not solve the large problem. So the way we look at it is that solve the larger problem and tell him that, okay, if you are interested in the more complex product, I think we will need a much longer time for us to be able to finalize. It's better you solve the smaller problem, larger problem, and then look at different products for solving the other problems that you have in your life.
So for most, keeping it simple works very well. So
Yes.
Yeah, okay. But I also want to talk about bundle plans, your insurance come investment plans, which is what are very popular in the market. Kapil, I want to ask you, is there merit in buying a bundled plan, or is it better to keep the two separate, your investment and insurance?
I think the answer to that is actually quite clear, that you should not bundle the two things. And this is not, it's obviously true in India. In the US, about 25 years ago, we used to have a market very similar to what is happening here, and there was a whole theme over there that invest in term, buy term, invest the rest. The issue in bundling is twofold. One is in transparency, and the second is in flexibility. So transparency, what happens is that when you bundle a plan together, you buy a traditional endowment, which is 60% of the market. You are getting returns which may be 2, 3, 4% returns, and you may be paying a mortality charge, which is for your sort of death, which is 1.5 to 2 times, sometimes a little higher, what you would otherwise have paid, and you can't make out. You've got this plan and you can't make out that this is what's happening. The moment you split it up into 2 plans, and then what happens is that you get your term rates which are comparable and competitive and low, and then for your investment a whole variety of options open up, because it can be mutual funds, it can be bank deposit, XYZ, insurance, ULIPs, whatever. So that I think the transparency is very important. The rigidity is also very important, because when you buy a life insurance plan, generally speaking, again the 60% of the market, you are in it for life. It's very hard to get out of it, because if you do, then the charges and the penal interest rates are so high.
Porting out is a problem.
But if you disaggregate and you buy term separately, term is, if you find you don't need the term, you switch off. If you want to get more term, you buy another term to sort of sit over it. And so your degree of freedom and flexibility is much higher. So I think you should just actually, this is one case when you should disaggregate
Keep it separate.
and treat the two separate.
Okay. Priya, what's your view? Do you think there are customers out there for whom bundled products, bundled insurance cum investment plan will actually make sense? So what's your view on bundling, and then if there is a customer segment that could benefit from these plans?
So all insurance products, are formed out of the base, which is a term plan, right? You bolt on a savings plan to it, becomes an endowment. You bolt on a mutual fund to it, it becomes a ULIP. Out of the two, we don't recommend endowments for the very reasons that Kapil was speaking about. Of course, the majority of the plans that we sell are term plans, because for us, we really look at life insurance as not as a lifelong thing, as a stopgap measure, because you are at a certain point in your life today, you've built up a certain amount of assets, you need to get to a certain point in the next few years before you retire, and what is that corpus that you need to get to? And therefore, what is the gap between where you are right now and where you need to be, right? That gap has to be filled by insurance. And that's not like a refrigerator that you buy at one point of time and then you fill it, shut it, and forget it. It doesn't work that way. It has to be reviewed very often. So from the perspective of simplicity, so if I'm recommending a term plan to somebody today for a certain level of cover, that may not be the level of cover he requires 5 years later. It will be lesser, because he's already built up assets between now and then. So we close out one of the term covers, and then the other one continues till he gets to that point when he needs to be. So from the perspective of simplicity, I do believe term suits the purpose very well. We don't believe in attaching many riders to it, because I'll come to that in a bit, because like I said, a term plan tenure is very different from a rider tenure, right? A critical illness is something that you can be exposed to for the rest of your life, but a term plan could be something that you need for only 5, 6, 7, maybe 10 years. So they're two very different objectives. Coming back to your point on whether a bundle product works, I do believe that a ULIP works for some people, and particularly in the case of children's insurance policies, because you can't look at everything from the perspective of an IRR, right? A return. Could I have done this better, or could I have done this better? And having said that also, sometimes the combination of a mutual fund plus term works out to be more expensive than a ULIP. Because in a ULIP, if you look at the mortality cost, right, it increases every year, because you may be 30 years of age today, next year you'll be 31, 32, and so on and so forth. So the mortality cost actually increases with age. In a term plan, it's a level paying premium. You pay the same premium, and so it's kind of front-loaded in the initial years, and it becomes sort of cheaper towards the end. So when you look at a ULIP and you compare it with a mutual fund plus term, after the 7th or 8th year, it actually starts to become a cheaper product than a mutual fund plus a term combination. Also because of the fact that a term plan is something that requires you to be quite diligent about paying the premiums every year, even though you set up an ECS and everything. People change banks, ECS can get rejected. Some of those plans tend to lapse after a period of time. Whereas at least in a ULIP, you have some sense of continuity that will happen for some time. Also because of the fact that a children's education plan takes care of the fact that if you're not there, the insurance company will pay the premium on your behalf, thereby ensuring that the goal doesn't get compromised in the future. So, for some reasons, such as a non-negotiable goal that I mentioned earlier, such a child education plan, I think it makes sense to take a ULIP. And I'm not saying that should be the primary product. I think, there's an accumulation stage that can be done through various products. If it's a goal that is a non-negotiable goal, insurance does it in a beautiful way in taking care of those risks. So I think from these two perspectives, it does make sense.
Okay, so let's talk about health insurance now. And again, in the health insurance space, there are various products. You have your basic indemnity, you have products that cover your outpatient treatment, there are products that cover hospital cash, that give you hospital cash. So again, the choice is unlimited. Now, what should be your smart strategy when it comes to health insurance? Deepu, I want you to answer this.
So health is, a very touchy area for most people, because that's one space in GI where the customer insures himself. Otherwise, it's all it's about asset insurance. Typically, there are two kinds of products, like you're aware. One is the indemnity product, and the other is the benefit product. So the smart
Indemnity pays for your hospitalization.
Yeah.
It will pay your hospitalization.
Exactly, and then the benefit product is where you contact, and then you get the cash, irrespective of the bill. So a smart strategy for let's say a family of four, would be to have a family floater which can serve as an indemnity product. And on the benefit side, if you look at what can typically happen, take a personal accident cover. Take also, a loan protection cover, because a lot of people today, also have, liabilities. OPD could be an add-on, which is, and hospital cash, are add-ons, as part of, these products. And of course, take critical illness cover. So I think these 4-5 covers could be a smart set. And today there are various ways, in which you can cut through the clutter. There are many independent surveys, including your own publication, as well as intermediaries, who can help customers. There are plenty of online sites, right? So if people are able to, look at independent sites, they can cut through the clutter and just pick this basket of 4-5 products. And at the point that we made, it's about keeping it very simple. What's your need? List down those 4-5 needs and just pick those products.